studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
This slide introduces one of the most important realities in tax planning. Two people can earn exactly the same amount of income and still pay very different amounts of tax. At first, that may seem surprising. Many people assume that income alone determines tax outcomes. But in reality, tax calculations are influenced by many other factors. One of the most important factors is personal tax credits. Let's start with the center of the slide. Notice that both clients earn exactly the same amount of income, $100,000. The income amount is identical. The starting point is exactly the same, yet the final tax results are very different. Why? The answer lies in the tax credits available to each individual. Let's look at Client A on the left side of the slide. Client A has access to multiple tax credits. Examples shown here include the disability tax credit, tuition credits, medical expense credits, and caregiver credits. Each of these credits can help reduce the amount of tax ultimately payable. The result is that client A keeps more of their income after taxes. Notice the flow shown on the slide. Income is earned. Tax credits are applied. Tax payable is reduced. And the final outcome is lower tax owing. The key lesson is that tax credits create value. They directly affect the individual's overall tax position. Now let's compare that to Client B on the right side of the slide. Client B earns the exact same $100,000. The income amount is identical. However, Client B has few or no significant tax credits available. As a result, there are fewer opportunities to reduce the tax bill. The flow is very different. Income is earned. Few credits are available. Less tax reduction occurs. And the result is higher tax owing. This comparison illustrates a fundamental principle of tax planning. The same income does not automatically produce the same tax result. Personal circumstances matter. That is why the large message in the center of the slide is so important. Same income does not mean same tax result. Professional advisors understand this concept very well. That is why the advisor's speech bubble says, "Every client's tax situation is different." This statement may sound simple, but it has enormous implications for compensation planning. Many salary versus dividend discussions focus only on tax rates. But experienced advisors know that personal tax credits can significantly change the outcome. A strategy that works well for one client may be far less effective for another client, with a different set of credits and deductions. This is one of the reasons why generic tax advice can be dangerous. What works perfectly for one taxpayer may not work nearly as well for someone else. Professional planning requires looking at the actual client, their credits, their circumstances, their family situation, and their overall tax profile. At the bottom of the slide, we see the key message. Tax credits can significantly affect compensation planning decisions. This means that before recommending salary, dividends, or a combination of both, advisors should evaluate how personal tax credits interact with the client's compensation strategy. The goal is not simply to calculate tax. The goal is to identify the compensation structure that produces the best overall outcome for that specific client. And that starts by recognizing a simple truth. Two clients with the same income can have very different tax results. That understanding forms the foundation for personalized compensation planning and sets the stage for the more advanced strategies we'll explore next. This slide builds on the idea introduced in the previous slide and shows how tax credits directly affect salary versus dividend planning. Many people approach compensation planning by asking a simple question: should I take salary or dividends? But professional advisors know that the real question is much more complex. The correct answer often depends on the client's personal tax profile. Let's walk through the planning process shown on the slide. The first step is determining that compensation is needed. The corporation has generated profits, and the owner needs to decide how to extract money from the business. At this point, many people immediately jump to comparing salary and dividends. However, experienced advisors know there is another critical step that must happen first. That brings us to step 2, reviewing available tax credits. Before running compensation calculations, the advisor examines the client's tax situation. Do they have a disability tax credit, tuition credits, medical expense credits, caregiver credits, age-related credits, or other tax attributes that may affect the final tax result? These credits can significantly reduce tax payable and may change the effectiveness of different compensation strategies. This step is important because compensation planning is not happening in a vacuum. The client's personal circumstances matter. Now we move to step 3, comparing salary and dividend outcomes. On the left side, we have the salary strategy. Salary creates earned income. It may generate CPP contributions. It affects our RSP contribution rule, and it interacts with personal tax credits in specific ways. On the right side, we have the dividend strategy. Dividends are taxed differently. They may benefit from dividend tax credits. They do not create earned income, and they may interact differently with the client's overall tax profile. At this stage, the advisor is not guessing. The advisor is modeling both scenarios. The goal is to determine how each option performs when combined with the client's actual tax credits and personal circumstances. Notice the highlighted message in the center of the slide. Tax credits may increase the value of one compensation method over another. This is one of the most important lessons in compensation planning. A strategy that appears optimal for one client may not be optimal for another. The reason is simple. Different clients have different tax credits, different deductions, different family situations, and different financial goals. That brings us to step 4, calculating the final tax result. This is where everything comes together. The advisor evaluates total income, applies deductions, applies available tax credits, and calculates the final tax liability under each compensation option. Only after completing this analysis can the advisor identify the strategy that produces the best after-tax result. Notice the scale shown in the tax result comparison. The purpose is not to prove that salary is always better, and it is not to prove that dividends are always better. The purpose is to identify which option works best for that specific client. The advisor's message at the bottom of the slide captures this perfectly. Always run the numbers using the client's actual tax profile. This statement highlights the difference between generic advice and professional planning. Generic advice relies on rules of thumb. Professional advice relies on personalized analysis. The client tax profile shown on the slide reinforces this idea. Income sources, tax credits, deductions, family circumstances, and provincial tax rules all influence the final recommendation. That is why compensation planning should never be based solely on general assumptions. At the bottom of the slide, we see the key takeaway. Tax credits can change which compensation strategy is optimal. This means that the best salary versus dividend decision cannot be determined by looking at compensation alone. It must be evaluated within the context of the client's complete tax picture. And that is exactly how professional advisors approach compensation planning. They do not ask what works best in general. They ask what works best for this specific client. That personalized approach is what leads to more accurate recommendations, better tax efficiency, and stronger long-term outcomes. This slide brings together the most important lesson from the entire tax credit planning scenario. Professional advisors do not make compensation recommendations using simple formulas. They make recommendations using the client's complete tax picture. At the center of the slide, we see an advisor meeting with a client and reviewing a personalized tax plan. This image represents the core idea behind professional compensation planning. Every recommendation should be based on the individual client, not on a generic rule of thumb. Notice the message in the center of the diagram. The compensation decision is informed by the complete tax picture. That statement captures the entire philosophy of this slide. The decision between salary and dividends should never be based on a single factor. Instead, it should be based on a combination of factors working together. Let's look at those factors one by one. The first factor is salary strategy. The advisor evaluates how much salary should be paid and how that salary affects taxes, CPP contributions, RRSP room, and long-term planning opportunities. The second factor is dividend strategy. The advisor examines how dividends fit into the client's overall tax situation and whether dividend income creates a better after-tax outcome. The third factor is personal tax credits. This is the focus of our current scenario. Tax credits can significantly influence the effectiveness of different compensation methods. Two clients with identical income may achieve very different results because of the credits available to them. The fourth factor is income level. The advisor considers not only the amount of compensation, but also how that compensation interacts with tax brackets and other income sources. The fifth factor is family situation, family structure, dependent, spouse income, and family tax planning opportunities can all affect the optimal compensation strategy. The sixth factor is long-term goals. Today's compensation decision should support future objectives such as retirement planning, wealth accumulation, business succession, and financial security. Now compare the two approaches shown on the left and right sides of the slide. On the left, we see generic planning. This approach relies on standard rules and broad assumptions. It uses the same framework for everyone. While it may be simple, it often overlooks important client-specific details. On the right, we see professional planning. This approach is customized for the client. It incorporates personal tax credits, income levels, family circumstances, provincial tax rules, goals and priorities, and the overall financial strategy. Rather than applying a formula, the advisor builds a recommendation around the client's actual situation. This is why the advisor's speech bubble is so important. The best strategy depends on the client, not the formula. That statement perfectly summarizes professional tax planning. The objective is not to find the strategy that works best in theory. The objective is to find the strategy that works best for the specific individual sitting across the table. At the bottom of the slide, we see the results of personalized compensation planning, more accurate recommendations, better tax efficiency, personalized planning, improved client outcomes, and stronger advisor value. These benefits are achieved because the advisor is making decisions based on real data rather than assumptions. The result is a strategy that is tailored to the client's unique circumstances. This creates better outcomes and often strengthens the relationship between advisor and client. And that brings us to the key message at the bottom of the slide. Great compensation planning starts with understanding the client's entire tax picture. The salary versus dividend decision is rarely about one number. It is about understanding how compensation interacts with tax credits, income levels, family circumstances, and long-term goals. When all of those factors are considered together, Advisors can deliver recommendations that are more accurate, more strategic, and ultimately more valuable for the client. That is what professional compensation planning is all about.